Today, we compare indexed universal life and whole life, using real policy math, not marketing illustrations. We will focus on cash value projections, fee drag, and what actually drives outcomes. First, whole life is simple. You pay a level premium. The policy has guaranteed cash value growth, plus potential dividends if it is a participating policy. Costs are built in and front-loaded, but the structure is predictable. Indexed universal life is flexible, and that flexibility is the risk. Premiums can vary, death benefit options can vary, and the cash value is credited based on an index. Strategy: you usually get a cap and sometimes a participation rate, and you typically have a floor. The floor sounds comforting, but it does not mean your cash value cannot go down. Here is why. IUL has ongoing charges that come out every month. Cost of insurance, policy administration charges, rider charges if you add them, premium load, sometimes asset-based charges. If the index credit is low, those charges still come out, and the cash value can decline. Now let's talk about the math that most people skip. What matters is your net crediting rate after all charges. If your index strategy credits 6% in a year, but total internal costs are 4%, your net is about 2%. In a flat year, where the strategy credits 0% because of caps and resets, your net could be negative because the charges still apply. Sequence of returns matters more in IUL than people expect. Early years are the most fragile because fees are a larger percentage of a smaller cash value. Weak crediting early can cause long-term damage. That is where you see premium increases, reduced performance, or policies that need rescue funding later. Whole life has a different pattern. It also has heavy early costs, and cash value is typically low in the first years. But after the break-in period, the growth pattern tends to be steadier because the guarantees and dividend mechanics are less volatile than index crediting. To compare fairly, you need the same inputs, same death benefit, same premium schedule, same funding period, same loan assumptions if you plan to borrow. And you need to look at year-by-year cash values, not just one point in year 30. For IUL projections, use conservative assumptions. Do not use the maximum illustrated rate. Instead, model a range like 4%, 5%, 6% gross credit. Then subtract realistic policy charges. Also model a long flat period because it happens. Then check whether the policy still works without extra premiums. For whole life projections, separate guarantees from non-guaranteed values. Show the guaranteed cash value line. Then show the current dividend scale line. And the dividends can change because they can. Now fees, let's name the biggest ones. In whole life, the biggest drag is the early expense load and commissions built into premium structure. After that, the ongoing internal costs are less visible, but generally more stable. In IUL, the cost of insurance can rise with age and can rise with worse than expected experience, plus the monthly policy charges persist, and the premium load hits every contribution. When people say IUL has no fees, that is incorrect. The fees are inside the chassis, and you feel them as lower net crediting and higher required funding. So which one wins? It depends on your goal and your risk tolerance. If you want maximum predictability and long-term stability, whole life is usually the cleaner fit. If you want flexibility and you can overfund aggressively, monitor annually, and accept performance uncertainty, IUL can work. but only with conservative assumptions and disciplined management. The decision should be made with real math. Request an in-force illustration template, run conservative rates, and verify what happens in flat years. If the policy only works at optimistic crediting, it is not a plan, it is the hope. Whole life is designed to be stable. You pay a level premium, the death benefit is generally level, and the cash value grows along a schedule with guarantees. If the policy is participating, dividends may add additional value, but dividends are not guaranteed. The point is consistency. You can usually map the path with pure surprises. Indexed universal life is designed to be flexible. Premiums can be adjusted. Death benefit options can be adjusted. Cash value crediting is tied to an index strategy, usually with a cap, sometimes with a participation rate, and usually with a floor. The point is optional. You can put more in, pull more out, change things, and potentially capture upside when markets do well. But flexibility is not free. It comes with moving parts, and moving parts create risk. Now we define the core question. How much cash value do you really build? And how much of your premium is consumed by internal charges? That is the whole game. Let's talk about the early years, because early years are where most of the truth lives. Both products have heavy friction early. In whole life, the early friction is mostly structural. Upfront, acquisition costs, commissions, and reserves reduce early cash value. So the cash value in the first couple of years is typically low relative to premiums paid. That is not the secret. It is how the product is built. In IUL, the early friction is also real, but it is distributed differently. You can see premium loads, policy fees, and rider charges from day one. And you can see the cost of insurance being deducted monthly. Because the cash value is usually smaller early, those monthly charges can be a large percentage of the account value. That means early performance matters. A few weak years early can create a hole that is hard to climb out of later. Here is the most important concept in this whole comparison. Net growth is what counts, not indexed returns, not illustrated rates. Net growth after all policy charges. If the index strategy credits 7% gross, but the internal charges consume 4%, your net is about 3%. If the strategy credits 0%, in a flat year, your net might be negative because the charges still apply. So the floor on the index is not the floor on your cash value. That is a key difference most people misunderstand. Now, what are those charges in IUL? Start with premium load, a percent taken off each premium deposit. Then a fixed policy fee, monthly or annual. Then cost of insurance, deducted monthly based on net, amount at risk, age, underwriting class, and policy design. Then rider charges if you add living benefits or other features. Sometimes there are asset-based charges. Sometimes there are per thousand charges on face amount. The menu varies by carrier, but the principle does not change. Charges come out regardless of index credit. Cost of insurance deserves special attention. It is not a flat number. It generally increases as you get older, and it can be higher if the policy has lower cash value relative to death benefit. That is why overfunding matters. More cash value reduces the net amount at risk, which can reduce the cost of insurance drag, but overfunding